Hello, YouTube. How is everybody doing today? Well, it's a really good day at my channel today. We have Jay Pestrichelli, the head trader from now Tidal Financial, no longer at Zega. Is that right? So, what's it like? Is Tidal? What's the culture like at Tidal? Pretty good.
Yeah, so let me explain that real quick. So you're right. As of the beginning of this year, Tidal acquired the trading business of Zega Financial. Basically, what that means is we just picked up our people that were Zega and we dropped them all into Tidal. So now we're all Tidal employees, exact same people doing the exact same job, just now one company. And it made sense for a couple reasons, capacity wise, structure wise. Quite frankly, we're both growing so quickly. It made sense to kind of use shared resources, like one HR department, one insurance policy, all those kind of things coming under one umbrella. And now the all of trading is under me at Tidal. Tidal, by the way, already had an existing fairly robust trading team that was handling a lot of the trading of other ETFs. I'm going to round 30 billion that Tidal has in its trusts and trading and sub-advising work. Zega type funds were only 10 billion of it, right? So they're already managing 20 billion of it. So now, the two teams are coming together. We're working on integrating those teams. It's a great culture, right? I wouldn't have done the move if it wasn't a good fit. Let's face it, we were a great team together, two great partners building some really unique and creative products. That's only going to continue to occur even more now that, all the other, I'll say operational stuff of running a company, is off my plate with the, Zega Financial as an RIA. But no, it's great. I couldn't be happier. This is ultimately better for investors. It's ultimately better for more funds and more creative work.
Are you still a wealth manager, or do you just not do that much anymore, other than just for your own friends and family?
I still do have an advisor business called Zega Investments, not Zega Financial, Zega Investments. Yep, that still exists. That manages 600 plus million in assets, and it is individuals, and we kind of do separately managed accounts for other advisors as well. That still exists. That team is still running. I'm still involved with that company as well.
But isn't that business kind of going the way of the bowling alley? I mean, with ETFs and stuff now, come on. I
don't know. I like going bowling, Max.
I'm just joking. I do too, but you know what I mean? The ETFs are so much more efficient. And I just heard an interview with you that you did 3 days ago. A great interview, by the way. And you were talking about how, how in the old model with the SMAs, it was hard to get a customer from, you know what I'm saying?
Yeah, it's hard work. It's certainly look, the ETFs are much easier to adopt. And if you like a strategy and you want someone who knows how to trade it for you, then great, you could do that. The SMAs are appropriate for some clients when they want more of a custom build, right? The majority of the work from an options perspective, right? What I think where it matters is when you're doing custom work or you're actually doing some planning, right? Like not everybody even knows which ETFs to buy, right? So if you know what you want in your portfolio, great. ETFs are a great solution. If you're like, look, I have some money, I know I should be investing it. I don't feel like, the 60-40 model I heard about works for me. I need something else. Or I'm approaching retirement and I need protection. Or, hey, I've got $3 million and $2 million of it's in Apple. I feel like I'm taking too much risk, but my tax basis is so low, I can't do anything. Like those solutions, an options-based advisor is better than an ETF. But for broad-based do-it-yourself retail investors, yeah, ETFs are a greect solution, no doubt about it.
Aren't a lot of wealth managers just putting their clients in your ETFs, though? I mean, Yield Max or different ETFs.
They might use it as part of the solution, right?
Or the overall strategy.
Yeah, like look, some of the great things like YMAX is a perfect example, and even like YQQQ, which I know you want to talk about later. Those are great tools for an advisor to use as they're building out kind of a profile of what they're trying to deliver, right? That's the idea. Otherwise, they were trading the options themselves to create the income level, and maybe they'd rather be working on the relationship, working on planning, doing dinners, golf, steak dinners, whatever it is that advisors love to do versus actually sitting there and trading. Not all advisors love the trading part. Some do, some don't. Some would rather be more on the management of the relationship and the planning side of things. So yeah, advisors could use our products as well. And I would say this: we've yet to really see advisors adopt some of the option-based strategies and innovation that we've put out, whether it's Defiance or YieldMax or Nicholas and the other ones that are coming down the pipe. Like all of those are all kind of still too new for advisors to get comfortable with. You like the wirehouses, for example, won't even let you get on their platform until you got a 3-year track record or $100 million in a fund, right? So, that takes some time. Not everything's, what, Tesla's doing, for example. So yeah, it's, I think we've yet to even see the advisor community adopt some of these newer structures that we've put out.
There's decent funds or funds that I like, that never get to 50 million, or, they could still have utility in some cases that just aren't adopted for whatever reason. I wanted to ask you today about the dailies. There's a little bit of a controversy. People are saying that we're getting dailies, and it has something to do with the prospectus that leak. And I don't know. I don't even know if that prospectus is real. I wouldn't be surprised if it's fake. But is there anything you can say? I know you're in the quiet period.
What do you mean it's fake? Like there's a fake prospectus on Edgar?
Well, I'm on Edgar all the time. I look at Edgar every day, and why didn't I find that? I look every night, and somebody had to send it to me from my Discord. So yeah, that was one thought. I thought somebody could be playing a joke. That's one thought that went through my mind at first. Yeah, it was.
So when you say dailies, you don't mean traded daily. You mean daily distributions.
Daily payers, yeah.
Daily payers. So look, I could tell you that. There is definitely a prospectus that was filed by Defiance. I'm going to read you a line out of the prospectus because all I can comment about is what is in the prospectus.
Okay.
And it says in the additional fund attributes, the sentence says this: the fund will seek to provide daily income in the form of cash distributions. That seems pretty clear. Now, look, I will say this. This is a filing, right? Now we got to go through the 75-day review period from the SEC. I don't know if this is the way the fund will end up, but that is what it currently says in the prospectus. This, by the way, is the lightning spread prospectus, which you and I actually first talked about lightning spreads maybe 2 months ago.
I never told anyone. I never told a soul. Not anyway. But we did.
Yeah. And look, I will give credit to the gentleman that coined lightning spreads. I thought I came up with it, but a gentleman named Rob had come up with it first. I've talked to Rob. You've interviewed Rob, I think, before.
And I happen to have that information just by coincidence because I'd interviewed him the week before, and then you and I were talking about the lightning spread, and I said, no, wait, that's Rob's. Anyway, yeah, I talked to Rob.
So look, giving some credit, I thought I came up with it. He came up with it years before I did it. By the way, it just has to do, the idea here is being long stock and selling a put spread over the long stock. And the reason to me it looks like a lightning is because you have the trajectory of the stock, but at one point it zigzags up because you've got a little extra leverage in the P&L. So that is, how I've always defined the lightning spread. And, that is basically what this prospectus says. Let me see if I could give it. So it's buying long dated, deep in the money call options on an index, and then writing/selling put spreads on the index with 0 days till expiration, meaning this put spread expires at the end of the same day it is sold. That is straight out of the prospectus. I think that gives you an idea of what we're talking about.
It does, and I've stayed up late testing every tenor. I'm going back and back testing. I'm testing in the last 4 years that Trump was in office, and I figure I'm thinking I have no reason to think this. You didn't tell me this, but maybe you're bringing this fund out with just the anticipation of some volatility, and this fund is maybe more suited to take advantage of it. And I think that would be a fair assessment. But I'm just saying, if a guy wanted to trade this himself, what strikes would a guy use? I mean, if I wanted to do it in my own account, would I use like a 50 and a 30, or, would I sell the 50 by the 30, more like sell the 30 and buy the 10? I mean, do you have any idea how a guy might do that?
Okay. So
it's not in a book. It's not in the book.
No. It's not in the book.
Okay.
So look, it all depends how much risk you want to take, right? Where you want the payoff to be. Like all spreads, how deep in the money or how high or low your moneyness is. And in the case of put spreads, right, in the money means above where the market is trading. That will have a higher payoff, but lower probability, right? And if you want to have a higher probability of a payoff, like selling a 30 or selling a 40 delta, buying a 30 delta right out of the money, which is below the market, that is a higher chance of paying off, but a lower payoff, right? So it's all about where you want to find, the right return to risk ratio. For us, when I look at these things, we're in the business of generating premium. That's the goal here, right? And where is always the highest extrinsic? Right at the money.
60-40. You're going to do 60-40, I bet.
We may, right? I'm just saying it's look, these are dailies. Like that would be really wide to do on a daily, right? If I was doing a monthly, that might make more sense. So look, again, with can't give too much of the secret sauce away at this point. You'll figure it out day one, but I would, because you always figure our stuff out day one. But look, I would say if you're doing it to generate premium and extrinsic value, you're going to be near the money when it comes to what strikes you're going to sell. That's just broader option, accepted doctrine there. So I think that's probably, again, when you read this thing, that the goal here is to generate some income and definitely capture the upside growth. I think it makes sense. You should expect something like that. But again, that's just the idea of generating premium behind it.
Using a 90 delta, 90 option and using the 60-40 on the zero DTE, and like you say, that may be too wide, but you actually had you performed positive in 2022 from January to October, and that not many other strategies can say that. Some of my strategies could say that, of course, but seriously, that's rare, and I don't know that by the time the fund comes out, it could be vastly different than whatever I put in the simulator, and also the simulator could have it wrong. But it's exciting that it has potential for outperformance. I don't know that it will, but it's exciting, I think.
Yeah, I mean, look, the what we talk about when you think about the risk graph of a put spread over a short put spread over a long stock is, if the market's up, you should be up more, right? You're kind of adding a little leverage in a defined range.
This wasn't on the list, but when I was back testing, I also just tested just the put spread. Just sell the daily put spread. And I've been telling you this, you should do this since day one. That doesn't back test terrible. It doesn't back test as well as also owning the in the money long option, but of course not, because the market usually drifts up. And my back test only goes back to 2012. So of course it's positive since 2012. So anyway, any guidance you could give me would be great, but I know that you can't talk too much about it, but I've dissected that fund every which way but Friday.
Good. I think we'll have a lot to talk about when that goes live. And again, like I said, it's filed. It may change, right? The SEC may come back and have us change stuff. Not sure what's going to end up being. That's why you can't make too much of comment too much about what's really going to be delivered at the end of it.
Well, and also you could change stuff, and that kind of goes into my next thing. It seems like at first you guys were more systematic, and lately especially with maybe Alti and LFGY and GPTY and SDTY, you're more discretionary. It seems like you're using more discretion in your trading and trading more aggressively. But it may still be systematic. I don't know. Am I right to say you're more discretionary?
Well, we gave ourselves more flexibility in the tactics that we were able to use. You're right. When Alti first went live, it was long stock or synthetic long with cover calls. That was it. And we realized you needed to add some flexibility when you decide to go after the most volatile tickers in the market, right? So using more discretion there. I would tell you that the zero DTEs, the SDTYs, we added in more flexibility. The thing about a fund is you're kind of defined and restricted by what the prospectus says. And it's easier for investors to understand when you're narrow and really discreet in your description. And so you get better understanding of what we may do. When you go wider and give yourself more choices, you may say, well, I don't know what they're going to do here. Like, are they going for growth? Is it hedged? It's more confusing, even though you may produce better total performance. So there's this fine line here of what you file and put in the prospectus, because investors will absolutely read it, as you know, versus what you end up wanting the flexibility when it comes to execution. But look, this is why we have these conversations, so we could talk through that, hopefully create some clarity when we broader in our tactics. But you're right, Max. We definitely got more, gave ourselves the ability to have more discretion when applicable, for sure.
So like on SDTY, I notice sometimes you seem to be very aggressive in your managing of that, more more so than you ever were in anything else that I followed of yours.
Yeah, well, yeah, it's fairly new, right?
Yes.
Are we even 2 weeks at this point? Maybe
I
2
don't know.
weeks right now.
Yeah,
And you're right. So this is so for those that don't know what SDTY is, it's a zero DTE strategy where in the morning we're selling a call over an existing deep at the money long call, right? So we're basically long the market, long the S&P and SDTY. Recently launched QDTY, so the NASDAQ as well. So we're long those markets through the use of a long dated flex option. This happens all the time. A lot of funds do this. And then we're selling a call in the morning at the open. But where we do get aggressive, Max, is if all of a sudden the market has moved and we could cover by that call back or maybe exchange that call for a higher strike price and unlock more of the upside, right? Because with a covered call, you are capped on the upside. Yeah, we're going to do that, right? We will run intraday trades in that portfolio, and we'll post those intraday. So these are the only funds that we're posting before the end of the day. All the other yield maxes get posted after we do our end of day file, and it's like 4:30, probably 4:30 that we end up posting those trades. But with these zero DTEs, we know that people want to know what we're doing today. How else will you know what the fund is supposed to do? So you're going to get the morning trade probably posted before the first 30 minutes, 10 o'clock.
Yeah.
Systems allowing, right? And then, then we're going to, if we do trades throughout the day, we'll post those fairly quickly right after we do that. So yeah, like this morning, I think the day is over. We could say this. We entered a NASDAQ and an S&P position as the market was down in the first few minutes, first half hour. We covered those, exchanged, and went higher in strike price to unlock more of the upside, took some of that profit that we had off the table in the short call, and then give ourselves, in case the market rallied, which, by the way, it did. Those last 10 minutes were kind of incredible today.
Now you've been making moves in there. I'm really enthusiastic about that. It seems like there's kind of like an arms race, or it seems like obviously the high yield business, covered call business, whatever you want to call it, liquid alt, whatever, it's obviously blown up. And I'd probably say it's safe to say the covered call are getting pretty saturated. They're freaking everywhere. I mean, you can't turn around without 4 of them opening, but it's such an exciting time to be an investor.
Especially in options, right? Like you're right. Like that is, it's great to kind of be, involved in this kind of this wave of adoption in the funds and options-based strategies for sure. Yeah.
Yeah. Why do you think that some of the inverse funds, because it's great. And all these funds have caught on really well. A lot of them have, but maybe not so much some of the inverse ones. And I heard you say in the other podcast that you were a little bit surprised. I kind of wanted you to expand on that or talk about that a little bit.
Yeah. So look, the inverse ones I thought are, again, let's go back to what I said a minute ago, where people have to understand what you're doing in a prospectus, right? And people hear covered calls intuitively, even if you only took options 101, what a covered call is, right? It's kind of the first tactic we'll learn. But if I told you a covered put, you're like, wait, is that a married put? Am I long? Am I short? Like, what is that? Wait, which side of the market am I on? So I think there's initially some confusion, again, with what it is, the fact that you have I've got a combo that replicates short stock. Okay. So I've got a long put in a short call that makes money when the market goes down. Okay. I think I get that. Great. Shorting feels a little uncomfortable. I like to say it's like Christmas in the Caribbean. Yeah, you're doing it. But it doesn't feel right when you get the gifts. So Christmas in the Caribbean. And then we do this short put for income that's farther down. And so I'm limiting my profit when the market's going down. It's just the dynamics are just a little different. So I think it's just going to take a little more time for investors to get comfortable with those funds and watching the dynamic of those. And then the other thing is, like you just said it, right? Markets generally go up, right? If you're going to look at a time period and you test, markets generally, right, go up. And so being short means you're probably also short in nature. in your position. Now, the beauty is when you pick single ticker stocks, it's not the index, right? You pick a Tesla or a Coinbase and you do the inverses of those. People may just hate those. Hate's the wrong word. They may just be bearish on those particular tickers. And so that's why we're doing those. But, when you look at the inverse that has the least amount of adoption and the least amount of assets, it's the inverse NASDAQ, the YQQQ. And that particular fund, has the least amount of assets in the inverse side of things. And while I thought it would be the most interesting to investors because it would allow you to lower the beta of your portfolio if you want to take risk off and get paid a distribution while you're waiting and taking the risk off. But yet it just hasn't been adopted. It may be more of, we may have to wait to get more of portfolio construction and, RAAs to adopt it into their models versus what we know now. The majority of our investors and a lot of these funds are more retail oriented folks. So, I think that's probably it. I wish I could put my thumb on it as to why, but I think they're strong products. I think they provide value in a portfolio. Sometimes I outsmart myself, Max. Sometimes I just, I think we can reference one of the funds that you and I liked a lot that doesn't exist anymore, Trez, right?
Yeah.
So, sometimes it's just not the right time for a product like that, right? The market's in a pretty.
We need to try again on the straddle strangle swap sometime in the future, but it was not the right time. But now that we're getting,
we closed that like 1 week too early, right?
I know that. I told you that.
August 1st. Sorry, Sylvia, I'm talking about the one fund we closed. Sorry. Right. And August 5th, you had the Japanese yen carry trade unwind, and TLT had all that volatility. The thing would have had a great month, but that's okay. That's just the way it is.
Do you do Sylvia? I should know this, but I don't care that much about leverage funds. But do you do Sylvia's leverage funds, like MSXX?
MSTX.
Or, yeah.
Yeah. So Tidal does, and Tidal is, trading falls under me. So I'm going to say the legacy Zega team doesn't trade those, but the existing Tidal team absolutely trades those. Right?
Okay.
So that is under my world. Yeah.
Well,
those guys do a great job there.
It's had some. I mean, that was tough luck on Tress, but she's had some huge home runs with your guys' guidance also, or with you guys, some gigantic home runs. I mean, anyway, especially in the leverage side of it, I've noticed. But no, that's great. Well, speaking of the market drifting up, and it kind of seems to do that, seems to kind of be a persistent phenomenon. Some of your competitors, Roundhill, had exploited that phenomenon by introducing the selling the options in the morning, the sub zero DT. I'm going to call that a sub zero DTE strategy. But anyway, it's been a huge success. It's brought a lot of assets under management. You've done something similar with your SPY-T product, and it's been a huge success also. But when it's kind of turned into a little bit of an arms race, because now you've got an SDTY product that's also trying to monetize the selling options in the morning. Now your niche is, though, you're trying to manage it more actively than them, I've noticed, but still it's a similar product. Well, then they say, well, hold my beer, and then they're releasing single stock stuff. I mean, it's like an all-out freaking war. I need to get a flak jacket, down here. I mean,
if you think you do, imagine me. So
I can imagine.
This is healthy competition, right? And I'm going to say something that's probably going to sound a little conceited, but when you're first and you're kind of leading the pack, you'll always have a bullseye on your back. We understand that. This is a competitive space. It's not like the leverage funds, which almost, like, you look at the indexes, like the triples, right? The ProShares and Direxion funds. They had this same arms race, 15 years ago. And then all of a sudden, right, the SEC said no more leveraged. And now those guys have kind of a monopoly on kind of the leveraged index space. Although I may have something for you shortly, Max, which we could talk about in about 3 weeks. But besides that, I would say this is very normal. There are other competitors besides the one that you mentioned. Look, it's healthy and it keeps us on our toes. I think we continue to innovate and put out stuff that is unique. We try to be first, and we try to put out products that, solve for a problem. And some of them are niche and some of them are a little wider. But yeah, it's okay. Like, I do not shy away from competition. It's the nature of the beast, right? So we want investors to choose what they want. If you like the flavor of somebody else's fund because maybe it doesn't have, they're holding back more distributions than we are, or whatever it may be, and we decide, hey, we want to distribute more. You pick which fits, your flavor. But I would say we've continued to see inflows. So even in the face of competition, our brands have continued to expand, and it's great. And people still appreciate what we're doing. We'll keep putting out new stuff and unique stuff as long as people want it. So obviously it's important to execute on what you have already, right? That goes without saying, but we're doing that, right? The team is now, the trading title team, I think, is 25 people at this point, right? We might possibly have the largest ETF trading team on the street right now. And so it's not a matter of resources. It's a matter of ingenuity and what we could put out there, and then executing on what we say we would do.
Well, yeah, like I say, it's exciting to see the arms race happen. What did you just hint at that you might have something to talk about in 3 weeks? The dog was doing something bad, and I was wrestling with him.
We were talking about ProShares and Direction having kind of a monopoly on the triple index products.
Okay. So I got you. I was just wondering what the hint was. I caught it now. All right. Well, I've also wanted to talk just real quick about GPTY. I think it's great, but specifically, I love the Q put hedge. Is that a permanent deal?
Yes. Wait, in GPTY, we have a hedge on that one, or are you thinking?
Well, you did. Don't you have triple Q? You have the 500 450 put spread.
Right. Yeah. Okay. Gotcha. So yeah, look, this is because we have that flexibility to kind of reduce some beta, right? To reduce some market volatility in those portfolios. We will do that when we can. Look, here's the thing about hedges, right? The tough, and I've been hedging forever. That's actually how I first started in the advisor business, was the hedged equity space. Hedging is one of those things that when you're hedging, it allows you to release the benefits of market timing. What do I mean by that? If you're hedged, you can time the hedge. You don't have to time your investment. So you can stay invested. You can be long the market, and you don't have to worry about when you're going to take risk on and take risk off. All you have to do is decide how tight or loose you want your hedges to be. Right. Sure. So it actually gives you the ability to stay invested, which we know generally long-term being invested over the long run is profitable, right? What's the S&P average over the last 50 years? 10% a year. That's great. I know this is a fund focused more on the AI and technology components, but the concept of having a basket of stocks, especially in technology, should go higher over time, right? And so the idea here is use the hedge as when you want to get, if you're bearish on the market, tighten up the hedge. Give yourself the ability to lower the losses and take some profit in a down move, and then even reinvest those gains from the hedge. So you end up having more exposure to the market on the way up than you had on the way down. That's the beauty of hedging. We call that the hedger's opportunity, where you take the profit and reinvest it so that you have money for the way up, more invested on the way up. You don't have to decide, should I pull back and be 80% invested, 30% invested? Stay invested, just manage your hedge. So to be able to apply that to some of these ETFs, we think is really important. Same thing with LFGY. We use a hedge on a Bitcoin index, the new SIBO. Actually, I think we use the micro version of it, the mini version of it. But still, we are investing in buying protection using a Bitcoin index over that LFGY portfolio. And it won't protect the idiosyncratic risk of a single stock, if you know what I mean by that term, right? Where something happened in a single stock that doesn't affect the whole industry. So it won't do that. But if Bitcoin has its next 80% sell-off or 60% sell-off, which it's done 3 times already, you don't know when the next one of those is around the corner. So I have the hedge on, right? Have it just as a broader protection over a basket of crypto-based stocks.
Well, I really haven't studied the LFGY hedge that much, but I'm more interested in the GPTY because I love that basket of stocks. I'm going to get that one soon. I really it looks to me like that hedge, when I put pencil and piece of paper to it, looks to me like it hedges out about half the downside. Is that, in a 5 to 10% drop. Now, it wouldn't hedge out half the downside in a 50% drop. I'm not saying that, but in a quick 4 or 5% pullback, looks like the market's down 5 and you have that on, the fund should be down 2.5 or 3. Is that?
Yeah, it'll start to buffer. Buffer's the wrong word. It'll start to offset some of those losses. You're right. And again, we're not hedging to zero, right? We're using a spread, right? We're not hedging from here all the way down to zero. We're hedging just a range to keep it more affordable, but still give you the ability to make some trades if you have a pullback.
Yeah.
And again, it's hard to know, right, the exact ratio of the stocks versus the hedge, but you're not wrong on kind of the range that we're shooting for.
Well, you have to look at the circuit breakers, and what's the circuit breaker at 8% or something, and that's where your hedges are. So I mean,
right.
I don't know if you've considered the circuit breakers, but I figure that's what I would have considered. But that, and you put your hedges outside of that, and that should, yeah. Well, I really like I just really liked specifically the GPTY. I think that's going to be a huge hit. I really, really like that fund. I want to switch base real quick, or switch tracks. I'm doing the weave like Trump does, and we're it also wasn't on the list. So I'm going to ask you political question. So what do you think about Doge? No, I'm just joking. Seriously though, what do you think? The new Trump administration has been saying they're going to cut back on regulations, and the Scott Bessent guy is a Wall Street darling. I've heard. I bet you guys are friends with him. You guys probably play golf together. But what do you think I'm just joking. Do you think that your industry is going to pick up any regulatory savings? And maybe even be able to pass it along in the expense ratio, or at least do you think you're going to be able to save some money with in the next 4 years? Are they going to roll back any regulations?
Yes. I think there's some benefits for the right regulation, right? The whole regulation that allowed us to kind of build the option-based strategies in ETFs wouldn't have come without changes to regulation that already existed, right? So I'm not opposed to all regulation here in our industry. Some regulation can be beneficial when done and unlocking the potential. I actually wish we had some more guidance from the OCC on things like collateral. And by the way, this is super boring to everybody, I know, but like collateral release on against short options, right? And like some stuff is fairly oppressive. So I would prefer more of a revision to some of the regulations. However, that being said, I would expect to start to see some easing a little bit certainly when it comes to kind of the crypto restrictions that we've seen in the past, right? Yeah. I think the market's already anticipating some of that work. That's the obvious answer to your question. You'll see it more there. So I think that will unlock more opportunity for investors to have more unique strategies available to them. And then I also think maybe the review process could get a little easier as well. Okay. Definitely changes in our space. So I don't want to speculate too much there. I don't know what it's going to do for costs. The actual, maybe our lawyers will charge us less for filing our funds, right?
I'm just joking. I didn't figure. I was being somewhat sarcastic. Expense ratios don't usually go down. I mean, I wish they would. But anyway, well. Do people give you a lot of trouble about your expense ratio? It is one of the highest in the business, isn't it?
Well, I think I would say it's commensurate with other options-based strategies that have the level of activity that we have, right? I mean, we're doing multiple trades in SDTY, said, right? Or
I'm not right.
No, I know you're not complaining, but it hasn't been the biggest pushback. I think advisors, unfortunately, have been trained to, take the fiduciary approach of cost first and appropriate and returns and build style second. Yes, an advisor has a fiduciary responsibility to look at, two funds that are the same. You got to go with the cheaper one, but you have to first make sure that they're the same, right? And so I think just advisors in general shy away from anything that's, in the neighborhood of 100 or 90 basis points. But quite frankly, that's the status quo across the industry. There's not a lot of, I don't think we're expensive compared to anybody else. I think we're par for the course with everybody. Yeah. It's not an advantage. We think it matters so much, right? When you're investing in funds and you're looking for total return, if you could save 5 basis points or 10 basis points, to me, that's less impactful than actually having the management to unlock even just 100 basis points or 1% extra it's worth it. So I haven't really felt like it's a major, roadblock for us so far, and neither of our competitors, because their pricing is similar.
Well, similar. I thought Round Hills was a little bit cheaper, but yeah, you're right. It's all right around the same ballpark.
Yeah.
But all right. Well, let's take this question. Here's a question. I'll put it on the screen. Question for Jay. What are his thoughts on the new Round Hill ETFs that will be paying weekly and are direct competitors of YieldMax? They will be kind of the same thing we were talking about a second ago, but I believe they're using leverage. Do you have any comments on leverage? I wanted to ask you about leverage as well myself.
All right. So here's a little bit of the leverage in the right amounts can be appropriate. Like all things, right? If you're expecting 120% yield, you should be expecting, a different profile in your set of returns, right? Like this is just all things. So let's take a step back. The dig on covered call strategies, right? Like YieldMax single stocks are, you take all the downside risk and you have limited upside, right? So now if you applied leverage to that, you're adding a leverage component to your downside risk, right? And you're still limiting your upside, right? So we have tested multiple versions of a leveraged YieldMax product, and we just did not like the results, right? YieldMax has been out for over 2 years. Did you think we didn't look at leverage already, right?
Oh, I'm sure.
People have been asking for a while, and we've shied away from it. Unless you nail the exact right stock, right? It's hard to have positive total returns in a leveraged fund that's selling calls, right?
What about unlocking leverage with options where you don't cost yourself extra downsides using ratio spreads or something?
Well, I would say that's not. So you're right. You could create these pockets like what we talked about with the lightning spread, where you have pockets of some leverage, and then that's okay, but you have to limit it. My understanding, and again, just reading the prospectuses, doesn't look like it's limited, right, in these.
Yeah.
And then the other point I'd bring up about weekly, look, there are times. This is I'll give you the perfect example. When is NVIDIA's earnings?
Yeah, well,
26, right?
Yeah.
It's a week and a half away. Well, right now it makes more sense to sell the options post NVIDIA's earnings instead of this Friday's options, right?
True.
So it's one of those things where I want to put on a 2-week trade. I want the flexibility to put on a 2-week trade. So if I'm paying you weekly, what are you going to get? Nothing next week for me and NVIDIA, right? I'm just using it as an example. I feel like it's a little too restrictive when it comes to the single tickers. Like you said, it's a little bit of an arms race, but ultimately, let's face it, it'll come down to total return and your distribution rate. Those are the things that I think matter to investors. What am I going to make? And what's the distribution rate going to be? And if it turns out it's a better mousetrap using leverage, which so far we have thought it is not, then so be it. Then that's okay. But I would say the weekly we've moved to weeklies on our YMAX because it made sense. We deliberately passed on moving to weeklies on our single stocks because we thought it would just the rate of returns would be too unpredictable, right? I think people come to expect different rate, expect a rate on MicroStrategy or Coinbase or Tesla.
So some of your strategies you do, I don't know if you do yet, but you filed a prospectus where you're doing a deep in the money strategy. But oftentimes you do a combo, which is an at the money put, a long call and a short put, usually at the money 90 days out or something like that. I don't know.
Yep.
What goes into the decision-making process? When do you use the poor man's covered call or the deep in the money as opposed to just doing the synthetic?
Yeah. So again, driven by the prospectus, right? We have to follow the guidelines. So the single stock YieldMax funds have to do the synthetic stock, right? So what drives how far out we go? Look, given the choice, I'd go out as long as I can. Actually, right now, if I could, and I can't, go out 1 year because the cost of carry is the least amount because the treasury rate on the 1 year is the least amount, right? So so without getting too nerdy, but if there's one person I can get nerdy with, it's you. There is this concept of cost of carry, right? And when you put on a synthetic, the market maker on the other side of your trade is giving up, because they have to hedge it, is giving up what they would make on their cash. And so they charge you for that in the trade, right? So when you go to execute it, it's not long stock, it's long stock plus the cost of carry, i.e. interest rates. So but don't worry, we buy a treasury as collateral and get it right back. So all of those things line up, right? And so it's okay for us, but I would rather put on a 1 year, but I can't because it ends up being too concentrated of a position in the single stock, right? So it ends up being too large. The market value of those positions exceeds ETF guidelines. So really the boring answer, I wish it was more interesting here, Max, was it's just meeting the kind of the guidelines of an ETF that you can't be over concentrated in a single stock.
Well, so if you did the deep in the money, that would put you over the 25% limit.
It could, right? So like, let's say it like really deep, like 50% of the money. Yeah.
Well, okay. Well, yeah, that would, but
I've got a 50%, call in that.
I was looking at a 90 delta, 90 day out, 90 delta on the SPX, and it costs $750. And, and that sells for 6,000 or something. So
yeah, it's on the SPX. Look at it on MicroStrategy.
Well, yeah. Okay. That's true. That's true. Yeah, that's true. I didn't think about that. But also, I thought people did the deep in the money because sometimes can't you pick up? I thought that sometimes people could do it, and when they use the one that's not that deep in the money. So also, it gives you some black swan protection. That if you have a crash in the stock, you only lose 20% or whatever you put into it.
Well, if you're only going long the call, that's true. But we're doing the synthetics, the combo, so you still
on the combo. Yeah, you have the whole exposure.
Yeah, it's 100 delta.
I'm just wondering if you've tested it the other way. I mean, yeah. You're right. It'd be more expensive, but isn't there some benefits to the poor man's covered call, or is there?
No, there are that you got to buy the treasury to pay for it, but you're paying for the cost of carry, so you're washed on that. So now you got all the time value and extrinsic in there.
Yeah.
You also have wider bid-ask spreads when you go too far in the money, right? They start to get a little wider, and your slippage on the fills is worse, right? So it's like there's no free lunch, there's no special way of building these. And by the way, the extrinsic is the same, right? It will cost you the same cost to carry regardless. So look, I will give you an example. Look at YBIT, where we have the flexibility to be concentrated because we're using an underlying ETF. In those scenarios, we're long a call. We're not doing a synthetic, right?
Sure.
We're not doing this. So when I can, I will use it, right?
Okay.
But, we're still trying to not have too much time bleed. The whole point of this is to be short theta and not long theta.
Yield max and to generate the most. No, I get you. I was just wondering. And the reason I was wondering though is because in the one that's been filed that you can't talk about, it's a different way. But I got you. I'll figure it out from what you said. Would you like to answer this question?
Sure.
Says, Misty was trading around mid-27 before ex-dividend date. I reinvested all my dividends back into the stock and yet still down. Anyway, appreciate the question, Omari.
Still down. So still down meaning the P&L or your balance is down, right? Your balance shouldn't be down except unless MicroStrategy moved up between the time and your dividends didn't buy enough back. But your balance, your position size is what matters, right? And so, I mean, it doesn't offset the fact that you have a decline in the ETF price, but you've now reinvested and your balance is bigger, but you have more shares at a lower price. You should have the same balance unless MicroStrategy moved and you weren't in that 1 day between the X date and the pay date. By the way, we deliberately make those as close as possible, the X date and the pay date. We don't make folks wait, 2 or 3 weeks anymore. We shrunk that down so you could reinvest right away and not have as much risk there. But it's when you say down, I would say I didn't look at what MicroStrategy did between X date and pay date last week, but you should have a similar balance. That should be the same.
Probably the price of the stock is down because of the ex-dividend, and I bet it hasn't recovered yet. I bet they're hoping for a faster recovery. But how does a faster recovery happen? Is that your fault whenever it doesn't recover fast?
I mean, MicroStrategy has to go up, or it could be sideways, and we sell calls, generate more income. The NAV will drift up, and then we're going to distribute what we made from that scenario right back. So the NAV will be flat. We're going to give you more cash. But MicroStrategy has to go up for the NAV to go up.
So if it goes down, I got you.
Yeah.
All right. Well, let's see what other questions we have. If you see any that you want to answer?
I saw one about, hey, can you stop doing the call spreads? Can you ease up on the call spreads?
You got to be kidding me. Anyway, would you like to answer that?
Well, I think it's a little misunderstanding on this, right? So I think you understand, and so maybe we can have an active dialogue on this. Did I lose you, Max? All right. So what happens here is, why are we paying for that long call when it continues to expire worthless? In particular, MicroStrategy is the one that's getting the most. We're getting the most questions, and you're right. We have been paying for long calls that have not gone in the money, that have expired worthless. And could it have been better if we did not? And I would say we're making the same amount of income. Like Misty is outperforming MSTR, I believe, in the last few weeks. And the reason being, look, there's something unique going on in MSTR right now. Its volatility is low compared to its historical numbers. And so, yes, we're paying for a call that we end up not monetizing. But when the volatility comes back, it could roar back. And so our risk here, when the vol on a MicroStrategy is down like it is, you're not getting paid just selling the covered call for the risk you're taking. So because the premiums are down, and like you want to be a buyer of volatility, you want to be a buyer of options when volatility is in the low end of its range. You want to be a seller of volatility when it's at the high end of its range. Well, MicroStrategy is low. And so look, we all know at any time something can happen in MicroStrategy and it's a coiled spring and we could see a 10% move. I would rather have a little tighter spread to the at the money than miss out the next time MicroStrategy has a plus 20% day, especially when it's so cheap to have that exposure. So, and also if you look at the chart of MicroStrategy, we're not at the high, we're kind of in the bottom, right? So you could have, and while we don't use charts to decide, where we sell our strikes, you obviously after a decline want to be prepared to participate in the upside. And again, we normally don't wait to go through the long call, right? We usually close those long, the whole spread when the extrinsic between the long and the short are equal, and it's a net zero extrinsic position, meaning there's no time value left in the spread. We'll roll. But in scenarios when the market is, you've got low volatility in MicroStrategy, you're not getting paid enough for the potential move that it's going to have when it comes, and you're at kind of the low end of the range, you want that extra upside protection. And while it may not seem great right now every day, you're still getting the same distribution rate. We've had to lower the volatility we're selling because the vol's down, right? So if you look at the amount of premium we're generating, it's down because volatility is down. You can only trade with the market that you're given. You can't create the market that doesn't exist for you. So yeah, I get it that it looks a little different, but there's absolutely a reason behind it. Whether you agree with it or not, that's our rationale.
I would sell my yield max if you switched it from the call spread. I think a lot of people would, but anyway, the call spread was genius. A lot of people don't realize it, but you can't judge it by 2 or 3 months performance. It may look like it hasn't worked out. When you put the call spread in a back tester and go back test it 15 years over being fully capped, you can see darn sure it works. It uncaps a ton of upside. But like anything else, it's a function of the market going up. The market has to go up. I mean, period. If it doesn't go up, there's nothing you can do. Hey, can you answer Alan's question about feed and 5E? Yes.
Look, so this is the one. This is the one where we're using Dorsey Wright to help us pick the underlying tickers, right? The stocks and the yield max corresponding yield max funds. It's based off of their momentum indicators. It's more of a Dorsey Wright question. So it says, how often do we think FEAT and FIVI index will update over the next 3 months? It depends on what the momentum indicators at Dorsey Wright tell us. And I don't have a lot of insight to share with you besides that, but I would tell you that historically, there's a reason why we partner with Dorsey Wright. They do a fairly decent job of identifying momentum. And you want to be long the stocks that have long upward momentum.
Well, I subscribed to their service, or I took out a trial subscription. Yeah, no, they're awesome. But I I was kind of hoping, and I think a lot of people are, I can kind of tell by the comments that they would be a little bit more active in their switching. I mean, you don't want something to switch every week, but at the same time, I mean, Tesla, are you serious? I mean, Jesus. I mean, at what point do they drop something? I mean, anyway, at least they don't have Murney. I don't know. So
I saw a Murney comment. Yes, I feel the pain of Murney with all of you. I got it. I know.
I have AMD and want to shoot myself. I mean, every day when I look at my tasty
like, how is that chip company not, like they're just not catching on? Is just investors are a little sour on AMD right now.
You guys do a great job at generating yield. I look at metrics and how it, and whatever. And it was, and also I did this 3 months ago, and it was, doing great as far as yield and paying and doing what it's supposed to do. But it just, the stock that underlying has not cooperated, and it just.
I'm reading Redfish's comments, right? Do you drop it? You're also long AMD. Redfish, how about we do an inverse Murney? Would you buy that one? You think, look, one way or another, something's going to happen with Murney.
Yeah.
With Moderna.
Yeah. Now, I want to talk about this one real quick, because this is one of my questions. What I was going to tell you, I don't know, maybe I could even share it. No, because it was on my iPad. Anyway, Alti, I pulled up a 6-month comparison of Alti to every index out there, the Qs, the SPY, the diamonds, and IWM, whatever that is, the RUT. It's throttling all of them. Throttling. By
total return looks good, right?
I mean, I don't see Alti not going up. Alti's NAV may not go up, but Alti's, it's. I'll let you comment, Jay.
No, you got it right. So I hope the expectation for Alti is, because we have a 80, 90, 100% distribution rate, that the fund will go up 80, 90, 100% a year. That's not like, that would be a heck of a fund, right? Like, that'd be pretty good. That'd be like something nobody does on Wall Street. So it's more about, again, harvesting the volatility out of the most volatile stocks. And I think we've done a strong job of protecting ourselves now, reducing the volatility of the overall fund through things like, protected puts and using spreads as a replacement, right? And getting long the stocks that have the potential to pop around earnings, right? I think, UPST earnings beat last week, and you captured a lot of the upside on that. Like, it's one of those things that
you got
performance.
Yeah, go ahead.
I was going to say the performance of Alti should be judged by the total return, right? Like, ultimately, that's the portfolio we're building, and even keeping up with the indexes with the most volatile and risky stocks in your portfolio feels like a win. Yet I think the general perception of Alti is, hey, when is the NAV going to go back to 20? It's probably never going back to 20.
Yeah. I mean,
unless we do a reverse split.
Yeah, exactly. That's and the NAV performance isn't strong, but I mean, but it's not supposed to be when it's paying 100% a year. It's more about how much NAV you can hang on to.
That's right. And look, reinvest, compound the dividend, compound the shares to get your dividends to grow. And if you're positive on total returns on top of that, that feels pretty great.
Yeah, and especially if you're more positive than the SPY is, or the Qs. I mean, that's insane. But Alti's definitely not for everyone. I was looking through my Tasty Trade, and it has a beta weighted alpha, or whatever that expression is, or whatever that metric is. Beta weighted alpha, a 5 or something compared to the SPY, 5.3 or just something. It has, because it has the stocks in there that are a hot mess, that potentially, but they're also the ones that are the hymns of the world. You guys got Planeteer during earnings, before earnings, right? That was gigantic. That was a home run. What people also don't realize is Alti is kind of a MAGA play. I mean, you guys have all the MAGA stuff in there, and you've been on the right side of that trade. And that's
plenty of crypto in there, plenty of semiconductors in there, right? There's
And you were prepared the other way too. You had a couple of solar companies in case Kamala pulled it off, but
those didn't work out so great. I'm glad we had a hedge on those.
Go woke, go broke. No, I mean, you'll baby drill. It's all about those pipelines and stuff.
There you go.
No, but it's a great time to be an investor on top of the fun stuff that's happening in politics and the economy, with all the fun stuff that's happening in options. At the core of it, really, I'm just an old option trader, and I'm excited that I have more people to talk about options with, and that people are learning that there's almost always a better way to do something. Anything you can do a stock, lots of times you can find a better way to construct it, and more maybe in 3 dimensions with options. And I just heard you just say that on another podcast today, and I think you and I
sounded really smart to me. That was good. That sounded great.
But I really like how options are coming to the masses, and that's kind of what I'm just trying to help you teach people, or to learn from you, and then try to help teach people. Let's see what other comments we have. We're right at an hour, right, and it's 6 o'clock there. You probably have reservations at the country club. You going to Mar-a-Lago?
Yeah, me and who'd you say I was golfing with? It's dark out. We're not golfing now.
I thought you might be going to dinner at Mar-a-Lago.
Right, sure. Yeah. I get invites all the time.
I'm just joking. Anyway, but no, I'm going to let you go, because you're very generous with your time, not just with our channel, but with all the channels. I see you on all the time, and we all really, or I could say I appreciate it a lot, and I think all my subscribers do as well. If there's any questions we didn't get to in here, guys, I'm sorry. Jay, can you tell us anything about your thoughts for maybe 2025, or is there anything you want to tell our community?
Look, I think we've touched on everything that is kind of going on that's new and interesting right now, Max. I would say thank you for your understanding of the deep understanding of the portfolios we've put together. I always like coming on because you're one of the, if not the most sophisticated channels that we go on and talk about. So kudos to you. So for all of your followers, you guys are following somebody that knows what he's talking about. What you don't know is that from time to time, Max and I will, chat a little bit about different strategies and what's going on. And, and so I think I've appreciated the partnership. So you guys are with a great channel here with Max. The other thing I would say is it's a repeat of stuff that I've said before, which is understand the risk that you're taking when you invest, especially when you're using single stock. Yield Max is right. You're taking single stock risk when it comes to those things. Use the Y Maxes or the YQQs if you want a little less volatility. Use some of those other index products, like some of the new ones, the SDTY, QDTY. If you're looking for more index exposure with option income, there's kind of a flavor for everybody. But just the one thing that you can control is the risk you take. So just always make sure you got a handle on it. And if you don't, ask Max. He'll tell you what your risk is. It's a perfect person to help you out. So ping him about it.
Well, thanks for being here, Jay. Hang out for just a second. I want to chat with you. All right, everybody. I'm going to dump you guys. You guys have
thanks, everybody.
Day. I'm going to cut the stream now, but evidently I started 2 live streams at once, and so I'm sorry if anyone went to the wrong live stream. I didn't mean to do that. I think Jay went to the wrong one too.
I did.
Oh my God. All right. Well, I need to be stopped. Everyone have a great evening, and I'll talk to you guys later.